Welcome to the Explainer. Grab your value investor hats, folks, because today we're diving into a genuinely fascinating corporate drama. We are looking at Vishay Technology. They're a legacy tech giant that is right in the middle of a massive strategic pivot. On one side, you've got this incredibly ambitious management team orchestrating a multi-billion-dollar transformation to capture the future of AI and e-mobility. But on the exact opposite side, you have Wall Street analysts absolutely ringing the alarm bells, pointing to crushed margins and severe downside risk. It is a classic textbook clash between a long-term, Buffett-style business quality thesis and rigorous near-term quantitative skepticism.
Okay, let's dive into this. Because the central mystery of our explainer today revolves around one staggering number. $2.6 billion. That is the size of Vishay's multi-year capital expenditure plan. Now, if you're a value investor assessing a company's economic moat, a capital allocation program of this absolute magnitude really only goes one of two ways. It's either a master stroke that's going to secure a durable competitive advantage for decades, or it's a massive destroyer of shareholder value. Management is literally betting the house on future growth here. But as we'll see in the data, the market is severely doubting their ability to actually execute it.
And when I say doubting, I mean they are projecting a brutal reality check. Based on recent analysts' consensus from MarketBeat, Wall Street is projecting a massive 48.33% downside from the stock's current trading levels. They're essentially saying this stock could get cut in half, arguing there's absolutely zero margin of safety at its current price. This creates a really powerful tension for us. Is the market completely mispricing a wonderful business, or is it accurately predicting a classic value trap? Well, here's our roadmap to figure that out. 1. Meet Vishay Technology. 2. The Vishay 3.0 strategy. 3. The Newport wafer fab. 4. Looking at the financials. 5. The bearish analyst outlook. And 6. Will the pivot work?
Let's start with Section 1. Meet Vishay Technology.
Founded back in 1962, Vishay is far from some flashy Silicon Valley startup. They are a deeply entrenched global leader manufacturing discrete semiconductors and passive components. You can kind of think of them as the vital plumbing of the tech world. In fact, they command an estimated 22.02% market share in their overall segment. They supply the critical, highly reliable components that go into automotive systems, industrial equipment, and, increasingly, high-performance AI hardware. Historically speaking, this level of market share and strict product necessity has provided them with a really solid, narrow economic moat. Moving on to Section 2, the Vishay 3.0 strategy. At the absolute heart of the Vishay 3.0 bull case are some aggressive growth initiatives. They are pouring that $2.6 billion into capital expenditures between 2023 and 2028. The ultimate goal? Dominating e-mobility and AI hardware. They are heavily focused on advanced silicon carbide or SiC MOSFET development, which is absolutely crucial for high-energy applications. They're targeting a 12% capacity increase in MOSFETs by 2025 alone. To put that potential into perspective, Vishay already provides over 80% of the bill of materials for some AI power applications. If the AI and EV megatrends hold up over the next 10 to 20 years, Vishay is positioning itself to be a completely indispensable supplier. Now, what's really interesting about this slide is how management is funding these massive ambitions. In September 2024, they announced a ruthless optimization of their global footprint. Step 1 involves immediately cutting around 170 SG&A jobs. Step 2 is closing 3 older manufacturing facilities across China, Germany, and Wisconsin by 2026. And Step 3 is realizing $23 million in annualized cost savings. As a value investor, this is exactly what you want to see when evaluating management quality. They're acting rationally with capital allocation, cutting the dead weight in legacy areas to aggressively fund high-margin, future-facing technologies. Section 3. The Newport wafer fab. A massive part of that footprint optimization we just talked about involved a pretty dramatic acquisition over in Wales. Let's look at the timeline of the Newport wafer fab saga. In July 2021, it was acquired by the Chinese-backed firm Nexperia. However, by November 2022, citing national security concerns, the UK government stepped in and ordered Nexperia to divest its ownership. Enter Vishay. In November 2023, they swooped in to acquire the fab for $177 million. From a pure business perspective, this was a major strategic win. It immediately secured critical material supply chains for Vishay's automotive expansions while saving 580 local jobs in the process. All right, let's get into the hard data with Section 4, looking at the financials.
Warren Buffett always says, you can't buy a stock just because it has a great story. And this brilliantly illustrates why. Because the deterioration in profitability between 2022 and 2024 is, well, it's shocking. Return on equity plummeted from a very healthy 20.99% all the way down to negative 1.46%. Operating margins practically vanished, collapsing from almost 18% down to barely above zero. And gross margins shed nearly 900 basis points, almost a full 9% drop. Now, sure, much of this is driven by the heavy integration costs of that Newport acquisition and broader restructuring charges, but still, these numbers show a company under immense immediate financial strain. The bottom line reflects this strain perfectly. For the full year 2024, Vishay reported a GAAP net loss of $31 million. This was driven by a significant top-line contraction, with revenue dropping from $3.40 billion in 2023 down to $2.94 billion in 2024. When you're pouring billions into capital expenditures while your current revenue is shrinking and your net income goes negative, you are stretching your balance sheet to the absolute limit. However, to be completely fair to management's financial engineering here, it is not all doom and gloom on the balance sheet. Despite those losses, Vishay actually maintains strong liquidity, finishing 2024 with $609 million in cash. Furthermore, they continue to pay a highly reliable 10-cent quarterly dividend to shareholders. They returned over $105 million to shareholders in 2024 through dividends and buybacks alone, which proves they're still generating enough cash flow to reward patient investors during this really painful transition period. Section 5. The bearish analyst outlook. So there is a massive disconnect right now between the current market price and the analyst estimates of intrinsic value. With the stock trading around $34.84, the consensus target is sitting way down at $18 flat. That implies analysts believe the stock is drastically overvalued today. They see absolutely no margin of safety, projecting that the market will eventually punish the stock by basically cutting it in half. So why are they so incredibly bearish? Well, the core arguments really boil down to massive execution risk. First off, building all this new capacity is great on paper, but if it remains underutilized, it's going to act as a heavy anchor dragging down returns on invested capital. Second, the heavy capital expenditure is risking persistent negative free cash flow over the next few years. And finally, to justify its current valuation and hit management's 2029 target of $4 billion in revenue, Vishay needs a flawless execution of an 8.9% yearly revenue growth rate. Analysts just don't believe they can pull that off in the current macro environment. Finally, Section 6. Will the pivot work? So the crucial point is looking at the forward trajectory rather than just staring in the rearview mirror. While 2024 was undeniably a major step backward down to $2.94 billion, the forecast for 2025 shows a stabilization and even a slight recovery up to $3.1 billion. But more importantly, in the first quarter of 2025, Vishay reported a book-to-bill ratio of 1.08. That means for every single dollar of product they shipped out, they received $1.08 in brand new orders. Demand is finally starting to outpace supply again, which might just be the first true green shoot of a turnaround. I think this quote from Simply Wall Street perfectly summarizes the dual-sided nature of investing in Vishay right now. Quote, "To own Vishay, you need to believe its heavy capacity build-out can eventually be filled with higher value products that improve margins, while recognizing the persistent losses remain central risks." Unquote. It's a textbook test of conviction. You're buying into management's long-term vision of AI and e-mobility dominance, while being fully aware that the short-term financials are going to be pretty ugly. Which leaves us with the ultimate question for any value investor looking at this stock today. Is Vishay Technology a deeply misunderstood value play, trading at a discount while it perfectly positions itself for the AI and automotive future? Or are the Wall Street quants right, and this heavy capital expenditure program is just a classic value trap waiting to spring a massive downside on investors? The strategy is in motion, the risks are super clear, but only time will reveal the true intrinsic value of the Vishay 3.0. Thanks for joining me on The Explainer, and remember, keep questioning the consensus.